Hey everybody! Investing in the stock market is intimidating due to the fact that other major players in the market have massive advantages over the retail investor. Today I'll be explaining what those advantages are and how that influences my investment strategies. When it comes to trading, institutional investors have numerous advantages over you. For example, after-hours trading is not readily available for the majority of retail investors. This allows institutional investors to trade when the market is closed to others and act on information released outside of regular hours. For example, companies will release quarterly earnings after the market has closed. Institutional investors have the opportunity to see this information before making a decision to buy or sell. It's like playing poker, but you can see everyone else's hand. It's a massive advantage. The next time you can trade again, the stock price has already reflected in the new results. Another advantage of institutional investors is through algorithmic trading. Institutional investors have access to sophisticated softwares to employ strategies such as high-frequency trading. This allows them to exploit any arbitrage opportunities that exist, and their trading speed allows them to act faster than any human or homemade algorithm. Finally, in order to understand how institutions control the market sentiment, let's first listen to a clip of Jim Cramer.
At my hedge fund, and I was positioned short, meaning I needed it down. I would create a level of activity beforehand that could drive the futures. It doesn't take much money. You can move it up and then fade it. That's often creates a very negative feel. So let's say you take a longer term view intraday, and you say, listen, I'm going to boost the futures, and then when the real sellers come in, real market comes in, they're going to knock it down. That's going to create a negative view. That's a strategy very worth doing. Yeah, Apple's very important to spread the rumor that that both Verizon and AT&T have decided they don't like the phone. Right. That's a very easy one to do because it's also you want to spread the rumor that it's not going to be ready for Macworld.
As you have just heard from those clips of Jim Cramer, there are many ways that institutions can affect market sentiment. This can be through the use of media, investor ratings, or even moving the price with large buy and sell orders. Since retail investors rely on these so-called financial experts for information and advice, this can be used to their advantage to dictate price movements. Institutional investors control the media narrative, and they use this to affect stock prices. The most commonly used tactic is the use of FUD to drive stock prices down. This is most commonly used by short sellers or firms with competing interests in order to suppress the stock price. Institutional investors can also influence stock prices through price targets and recommendations. For example, a high price target can influence investors to buy the stock, pushing the price upwards. This could give the firm opportunities to sell off their position. Finally, institutional investors can use pre-market trading to drive market sentiment. Since there are such low volumes of stocks being traded during these hours, a large buy or sell order can cause the stock price to shoot up or down. Investors seeing this can easily be tricked into panic buying or selling. So in summary, institutions have a huge advantage when trading based on information. They have a far faster reaction time and they can control the flow of information and market sentiment. Knowing this, I stay away from day trading and momentum-based trading strategies as I feel like I am at a huge disadvantage. Now it may seem impossible to beat the market, but there are some blind spots that we can take advantage of. Institutional investors are often heavily focused on short-term profits and overly emphasize quarterly and annual results. This is due to the fact that they need to demonstrate strong returns in order to attract more clients to their funds. This results in a systematic undervaluing of high-growth companies that reinvest their profits for growth. This can be seen over the past decade with companies such as Amazon and now Tesla. Another weakness of institutions is the over-reliance of financial models and metrics to project future outlooks. They're great to help support an investment thesis, but they aren't without their flaws. Financial models are heavily based on past information and rely on a number of assumptions in order to project out the future. While this works for stable and mature businesses, they are less effective at projecting out high-growth companies where both growth and new developments are hard to predict. Growth is often projected to be linear or declining over time, so any company that is growing exponentially will be heavily undervalued. Likewise, any company that creates new value through new products or innovations will be undervalued as these opportunities don't show up in the existing financial numbers. An example of this is Apple's invention of the iPhone, which created a whole new market for smartphones, not previously seen. Financial institutions often lack domain expertise in terms of understanding the business, technology, and products. This was most evident in the past year when seeing analysts talk about Nikola, When prominent YouTubers were noticing red flags with the companies, media outlets continued to talk as if Nikola would be a major competitor in the electric vehicle space. This weakness is most apparent when dealing with understanding of emerging technology. Putting it all together, I think the following few points can help create a strategy to beat the market. The first is a focus towards innovation and future growth. While investment in growth stocks is not a new strategy, current valuation methods have shown to systematically misvalue these types of companies. This creates an opportunity to find value amongst these companies. Second, not all growth companies are undervalued. In fact, some may be grossly overvalued. In order to determine which of these companies are undervalued, in-depth knowledge about the companies and industry are required. As a result, I think it's beneficial to have a narrow but deeper focus on several companies. Finally, as an investor with a long-term outlook, I'm looking to maximize my investment over a longer-term horizon. We need to remember to be patient and focus on the long-term outlook. It takes time for these businesses to execute, and maybe even longer for the stock market to recognize the value. The valuation of these stocks will often be volatile, but as long as the underlying business is growing, we should continue to be patient and hold. So to summarize everything today, institutional investors have many advantages over the retail investor. But despite that, there are still many stocks that are mispriced due to flaws in traditional valuation methods. As a result, my preferred trading style is to buy and hold in long-term growth and innovation. I feel like this helps stay away from areas where institutions hold all the major advantages and instead enter an area where companies are undervalued. Do you agree or disagree with my thoughts? Let me know in the comments below. What is your preferred trading style and why do you choose that particular investing style? So that's it for today's video. Thanks so much for watching and I'll see you next time.